Wealth continues to rise, while the shadows around us grow longer.
But the real secret is
Below,
something
the
far
tide
more
of reality
powerful.
slowly recedes,
High-income
revealing
Americans
much.
often keep more of their money because they understand how the tax system actually works. While the average worker sees taxes automatically disappear from every paycheck, wealthy individuals and business owners use legal strategies hidden inside the IRS tax code to reduce what they owe year after year. And here's the crazy part. Many of these strategies are completely available to ordinary people too, but most Americans never learn about them because schools rarely teach taxes, investing, or wealth building. Today, we're breaking down how high-income Americans legally pay less in taxes, how the system rewards investors and business owners differently from employees, and why understanding taxes may be one of the biggest financial advantages in America in 2026. Imagine two people earning the exact same amount of money every year. One is a salaried employee making $250,000 at a corporate job. The other earns $250,000 through investments, business ownership, and real estate. Even though both people made the same amount, they may end up paying dramatically different tax rates. That sounds unfair at first, but it happens because the US tax system is designed to encourage certain economic activities, like investing, entrepreneurship, retirement savings, and property ownership. The government wants people to create businesses, invest capital, buy homes, and stimulate economic growth. So instead of only rewarding high salaries, the tax code gives special advantages to people who structure income differently. One of the biggest differences starts with earned income versus investment income. When you work a normal W-2 job, your paycheck is taxed almost immediately through federal taxes, Social Security, Medicare, and sometimes state taxes. But wealthy Americans often generate income from stocks, dividends, real estate, or businesses. Long-term capital gains taxes are usually lower than ordinary income tax rates, which means someone making money from investments may pay a lower percentage than someone working a traditional job. This is one reason many millionaires focus heavily on assets rather than salaries. They understand that ownership creates tax flexibility. Another major strategy revolves around retirement accounts. High-income Americans maximize accounts like 401k plans, SEP IRAs, Roth IRAs, and health savings accounts because these accounts provide enormous tax advantages over time. Contributions to traditional retirement accounts can reduce taxable income immediately, while Roth accounts allow investments to grow tax-free for decades. Imagine investing money for 30 years without paying taxes on gains. That's one of the most powerful wealth-building tools available in the United States. Wealthy investors understand that taxes can quietly destroy investment growth, so they prioritize accounts that legally protect long-term compounding. Business ownership is another huge tax advantage. Employees usually have limited deductions, but business owners can deduct legitimate business expenses, including office costs, software, travel, marketing, equipment, internet bills, and sometimes even portions of home office expenses. This doesn't mean rich people avoid taxes illegally. It means the IRS allows businesses to subtract operating costs before calculating taxable profits. If a business earns $500,000 but spends $200,000 on legitimate business expenses, taxes are only paid on the remaining profit. Wealthy entrepreneurs understand how to structure spending strategically while still growing their companies. Real estate may be one of the biggest tax loopholes available to wealthy Americans. Investors use depreciation, mortgage interest deductions, property write-offs, and 1031 exchanges to reduce taxes legally. Depreciation is especially powerful because investors can deduct the wear and tear of a property even if the property is actually increasing in value. Think about that for a second. Someone could own an apartment building that gains hundreds of thousands of dollars in market value, while simultaneously reporting paper losses that reduce taxable income. This is why so many wealthy Americans invest heavily in real estate portfolios. Then there's the strategy of borrowing against assets instead of selling them. Many wealthy individuals avoid triggering taxable events by taking loans against stock portfolios or real estate holdings. Selling appreciated assets creates capital gains taxes, but borrowing against assets does not count as taxable income. This allows wealthy investors to access liquidity without immediately creating tax bills. Banks are often willing to lend money to people holding millions in assets because those investments act as collateral. This strategy helps preserve wealth while minimizing taxes legally. Another reason high-income Americans pay less taxes is because they understand timing. Tax planning is often about controlling when income appears on paper. Investors may delay selling assets until a future year with lower tax exposure. Business owners might accelerate deductions into one tax year while delaying revenue into another. Wealthy individuals work closely with CPAs and tax attorneys whose entire job is finding legal efficiencies within the tax code. Average Americans usually file taxes once a year and move on, but wealthy households treat taxes like a year-round financial strategy. One of the most misunderstood concepts in America is that the tax code is not simply a punishment system. It's also a behavior system. The government uses taxes to encourage certain activities. Retirement investing gets rewarded. Home ownership gets rewarded. Business creation gets rewarded. Energy-efficient investments get rewarded. Long-term investing gets rewarded. People who understand these incentives can legally reduce taxes while building wealth at the same time. That's why financial literacy matters so much. The wealthy often aren't just earning more money, they're playing a completely different financial game. Now, this doesn't mean every rich person is secretly avoiding taxes or breaking laws. There's a huge difference between tax avoidance and tax evasion. Tax avoidance means legally using deductions, credits, and strategies approved by the IRS. Tax evasion means illegally hiding income or lying on tax returns. One is smart financial planning. The other can lead to audits, fines, or prison. Wealthy Americans who succeed long-term usually hire professionals and stay within legal boundaries because protecting wealth also means protecting reputation and stability. The rise of AI and financial technology in 2026 is making these strategies even more accessible. Today, regular Americans can use apps to track deductions, automate investing, analyze tax loss harvesting opportunities, and optimize retirement contributions. Information that once belonged only to elite financial advisors is now available online for almost anyone willing to learn. This is changing the financial landscape because younger Americans are starting businesses earlier, investing sooner, and understanding taxes before reaching high income levels. But here's the biggest lesson of all. The wealthy don't just focus on how much money they make. They focus on how much money they keep. Two people can earn the same income and end up with completely different financial futures, depending on taxes, investments, debt management, and long-term strategy. Building wealth in America isn't only about working harder. It's also about understanding the financial system deeply enough to make smarter decisions over decades. At the end of the day, the US tax code is thousands of pages long, filled with incentives designed to reward certain behaviors. High-income Americans study those rules carefully, or hire experts who do it for them. And while not everyone can become a millionaire overnight, understanding how taxes work can completely change the way you think about money, investing, and financial freedom. The people who win financially in America are often the ones who learn the rules early, use legal strategies intelligently, and think long-term instead of paycheck to paycheck. Because in 2026, keeping more of your money may be just as important as earning it.